My whole philosophy is, how do we get business owners to divorce the IRS? There's nothing wrong with avoiding taxes. The IRS says you can avoid taxes as long as you take advantage of the tax code to your benefit. I have one of my colleagues, she has a good friend, has a cleaning business, and her net profit, $600,000. She paid $300 in taxes. Have you ever heard of the coined phrase by John D. Rockefeller, own nothing and control everything? That's what we do. Anything that's in your name is up for grabs. So it's actually 80 to 95%. And to believe it or not, even though that's high, that's conservative. So capital gains. How many business owners are selling their business? What percent do the business owners pay on the capital gains? 20%. If your trust owns the business, that business owner pays no taxes. 20 to 0. This is under contract law. Most contracts fall under legislative and tax law. This is under contract law. No judge can overturn this and see inside this trust. It is a blind trust. They cannot see the assets, the trustees, the beneficiaries. The ultra wealthy have been doing this. That's why the ultra wealthy pay the least in taxes compared to their income. And why haven't people heard about this? There are 15 active distributors in the country that can market this. You have to be invited to hear about it.
Welcome to another episode of Beyond the Bottom Line. I'm your host, Joey Lalonde. This show is about pulling back the curtains on how the ultra wealthy actually protect and grow their money without the gatekeeping and the complexity. Each week I sit down with elite experts working with top business owners and wealthy families to reveal practical strategies that business owners can use right now to keep more of what they earn and pay less in taxes legally. My guest today is none other than Michael Clanin, a business and estate planning strategist and owner of Safe Money Solutions, who helps business owners restructure their relationship with the IRS to reduce business risks, legal risks, and their tax liability, right? Michael is known for teaching entrepreneurs on how to keep more of what they earn using legal domestic strategies that the ultra wealthy rely on, but most CPAs never mention. So with that said, welcome to the show, Michael.
Hey, Joey, thanks for having me today. This is an honor.
It is an honor for me. I think it's going to be an honor for a lot of U.S. business owners watching this as well. I think you got a lot to share, and my goal today is going to be to have you extract as much tactical advice as I can on this show.
Let's dive in.
Awesome, Michael. So you use some pretty provocative language about business owners needing to restructure or divorce their relationship with the IRS using tax codes and legal structures and all that fun stuff. What do you mean by that, and how did you develop this philosophy about the relationship between successful entrepreneurs and the current tax system?
Yeah, well, let's just put it out there. I'm not an attorney. I'm not a CPA, so I'm not giving legal advice or recommendations as far as what to do, tax wise and that. So I'm always 100%. Upfront with that. What I have is the knowledge on this whole structure that we're going to talk about today. So as far as my whole philosophy is, how do we get business owners or people who have a lot of assets, a lot of wealth, how do we get them to divorce the IRS? Now, some people will say disinherit the IRS. Divorce is more strong in my world, right? Yep. The thing, Joey, is there's nothing wrong with avoiding taxes. The IRS says you can avoid taxes as long as you take advantage of the tax code to your benefit. What we don't do is we don't evade taxes. Tax evasion is illegal. So let's just put that out there, right? So we're not trying to do anything shady or anything, but what you're going to find out today is, this is one of those things. Why haven't I heard of it before? This is too good to be true, right? Yeah. But here's the thing. The ultra wealthy have been doing this. That's why the ultra wealthy pay the least in taxes compared to their income. They're taking advantage of the tax code. And the thing is, most CPAs don't even know this stuff. They're just doing the bookkeeping. They're doing, they're not strategists. They're not looking, they're reactive versus proactive. You're paying a lot in taxes. Oh, maybe next year we should do this. Yeah. No, Right? So my job with my clients is, how do we keep the money in the family? How do we keep it in our possession? Because we can do a lot more with it for our use versus giving it away to Uncle Sam, the tax man.
Yeah.
Right? He is your silent partner. He's not your uncle, guys. He's not your uncle.
That's true. We got to rename that one. But
Right?
but Michael, tell me, like, how or why do the ultra wealthy pay that low taxes when they make more money, and why do business owners think it's so out of reach to get the same strategies as them?
Well, I mean, here's the thing. Unless you are surrounding yourself with the ultra wealthy, you will never learn about these strategies, right? So my goal is to bring this more mainstream, because there are a lot of wealthy people. It doesn't mean you have to be, double millionaire digits, right? You could be a $2 to $3 million millionaire, right? And you're going to learn some of this. The strategy is about taxes, but it's also about protection and not losing control. Have you ever heard of the coined phrase by John D. Rockefeller? Own nothing and control everything.
Yep.
Okay. That's what we do. On paper, our clients, anything that's in your name is up for grabs. Right.
Yep.
Even your business, whether it's a limited liability company, whether it's an S Corp, C Corp election, or a straight S Corp, C Corp, LLP, your business can be sued. You have a lot to risk. Now, then there's the other side, being sued personally too. There are no protections. Okay. But what you're going to learn about today, if somebody sues you, they can't get one penny in what we're talking about today. Okay. So it is out there. And why haven't people heard about this? Well, I will tell you, I'm just a marketing arm from attorney firm that holds the copyright to the specific structure. Okay. I'm a marketing arm. There are 15 active distributors in the country that can market this. So you're not hearing it because you have to be invited to hear about it. Either you have to hear something like this, right? Somebody listening to your podcast. Somebody has to introduce you to me, or somebody like me, or maybe we've met through some other way, but you had to make a connection some way or somehow. This is not mass marketed out there. Yeah. I mean, there's a lot of, we're going to unpack. I don't really want to get into the weeds, but just know this is, my background, Joey, is before coming into the insurance financial world, I'm a former teacher. Okay. I just educate people, and I try to keep it as simple as possible, which that's not hard for me to do because I taught elementary. Okay. 20 years ago. Right. Yeah. I just tell my clients, I'm just a glorified educator that gets paid more than my wife for helping people save money. That's really good. But I also tell clients this, because Safe Money Solutions is exactly what it is. Everything that I offer my clients, number one, I own myself. So what we're talking about, I have to be a consumer of this product or service before I take it to a client. Why? Because I believe you need to own what you're going to pitch in, preaching. Okay. There's too many salespeople out there. I don't know how people can do what they do and they don't own a product. So I always tell that. I'm full transparency with clients on that. But the thing is, everything I do is contractually guaranteed. Yeah. With insurance-based products or contracts. My clients cannot lose one penny. I tell them, if you want to lose your money, your financial advisor owns that license to lose your money. He can't control the market. He can't control inflation. He can't control taxes. I put my clients in a position where we can control all those things, because we don't have to worry about what happens out here in the market, because their money is not directly in the market or in plans. Okay. I'm not saying that there's not a place for that, but when you're ahead, pull the chips off the table. right? And protect what you don't want to lose and risk what you're okay with losing. Okay.
That's a great way to start. I think there's a lot of ways I can unpack this, but just first the Rockefeller thing. I think what's the book? One of their famous.
What would the Rockefellers do? What would the Rockefellers do?
That's an amazing book to understand those concepts, right? And I think, like to your point, it's a relationship kind of network access to having access to those strategies. And a reasoning that I had while you were speaking was that perhaps the ultra wealthy, it hurts more, right? So the tax bill hurts even more. So they don't have a choice. When you're in your first millions, even 10 million, like you're going to pay a couple $100,000 in taxes, and you should, like, we're going to share that these strategies are still applicable definitely to you. But once you get to that 50 million and up, like those $10 million bills, they hurt. So you're way more incentivized and you have way more urgency to take action on that. So perhaps that's why, that's my theory. Maybe you can tell me what you think, but that these ultra wealthy has all of those already in place because it hurt and it stings a lot more.
Well, yeah, let's talk a little about that. Let's use the Rockefellers, okay? Yep. So the Rockefellers have built their wealth multiple ways, okay? But the thing is, what the Rockefellers put in place 150 years ago, I'm not even sure, those descendants, I think it's the 8th or 9th generation, are still benefiting from what they put in place decades ago. Okay, they don't have to start generationally and start all over. Now, the Vanderbilts, on the other hand, right, were very wealthy, but their wealth got squandered. I tell people that's why you see Anderson Cooper still working, because he's a descendant of the Vanderbilts. Yeah. Okay. So they have put things together inside these structures. Okay. So when somebody dies, and one of the ways they do this is with life insurance. Okay, now this is not a life insurance discussion, but it's important for people to know, right? Most middle class mentality, or people who have enough money, they're comfortable, right? Yep. Maybe they have no debt, they don't have kids at home, colleges are paid for, house paid for, whatever, right? Yep. Middle class mentality is, I don't have that. I don't need life insurance. So how many people retire without life insurance? Okay. Well, tell me why the ultra wealthy have millions and millions of dollars in tax-free life insurance. So the ultra wealthy is one group of people who own that cash value life insurance. You want to know the other entity that owns the most cash value life insurance?
What is it?
Banks. Banks are the number one owners of bank-owned life insurance. Google it, BOLI, B-O-L-I. They own more cash value life insurance than the buildings and the lands that they own. So if these strategies are good for the banks and the ultra wealthy, why are we not taking advantage of and listening? It's because I shouldn't say nobody, very few advisors are ever educated on this. This is not something that's out there in mainstream. I had to go out and find it and then learn about it, because I couldn't. A lot of the things that I do, Joey, it's a shift of mindset, right? Yeah. It's against the norm, right? And what I mean by that is I observe the masses and I do the opposite. So for example, how many people are putting into retirement accounts? 401ks, IRAs. Mm-hmm. Why are they doing it? Yeah. I ask people, why do you do that?
They got told about it.
They were told, get a job, get the 401k, get the match, and max it out. What they don't know is what they are creating, what kind of monster they are creating. And oh, by the way, you can't touch that money for 30 years. What's the freaking fun of that?
What is that monster? What is that monster they're building, if that's the strategy?
Well, they're building these tax deferred. All they're doing is kicking the can down the street, right? And then they're going to say, my gosh, now most people think they're going to be in a lower tax bracket in retirement. I can tell you, I've never ran anybody that wanted to be in a lower tax bracket because they didn't want to make less money. Yeah, of course. So the thing is, again, you and I are not in control of inflation and taxes. The deficit is at an all-time high. It's going to just continue. The only way to reduce it, two ways. One, government stop spending.
Yeah, it's not going to
I'm
happen.
sorry. I'm not going to count on that. The other is they have to raise taxes. So you got a little tax break today, right? At tax time, right? You kick the can down the road.
Yeah.
You're going to pay, instead of paying taxes on that dollar today, now you're going to pay it on $100 in the future. Taxes are going to go up. So now you're going to pay taxes at a higher income bracket, either because taxes went up or your income's gone up, to get back less. So again, one of the strategies we do, I'm just kind of explaining divorcing this. Let's talk about divorcing the IRS. How do we divorce the IRS and pay the taxes today so we don't have to pay them at an unknown tax rate? It's like going to the banker and saying, I need a loan for a house. And this banker who you've done banking with all your life says, you know what? We know you're credit worthy, you're trustworthy, you're honest. We'll give you the loan for $250,000. What's the one question you want to know, Joey, about that loan before you sign?
The interest
rate. What's that? What's the interest rate? Joey, don't worry about that. I'll tell you what it is in 30 years. Are you going to take the loan?
No, of course not.
But that's what people are doing on their retirement accounts. So how do we divorce the IRS? Okay, so there are strategies out here to divorce the IRS when doing Roth conversions and letting somebody else pay the taxes, meaning insurance companies paying the taxes. There's a strategy for that versus them pulling it out of their assets. Okay, but a financial advisor or a traditional insurance agent, they're narrow-minded. They're only looking at what they do.
Yeah.
They could care less what you're doing on your auto insurance, your life insurance, you have disability. They don't care but the thing is, I do, because guess what? If you don't have those in place, guess what? It's going to come back to your pocketbook. It's not the potholes that you see that you can maneuver around when you're driving. It's the ones that you can't see that cost you the most in the long run.
Yeah.
So why not uncover those potholes? And that's what I do with clients. I bring it to their attention and I bring them solutions, save money solutions, right? But it's ultimately up to them. Do they want to solve this problem? So all we're doing is addressing what if. What if you can't work? What if you go into the nursing home, right? What if, right? And then we're being proactive as much as they want to be and filling in those potholes permanently so they don't creep up again. Okay. And as you know, in the insurance business, there's some things you can get and there's some things you can't get at some point. Right? If you're healthy, you can get life insurance. If you're not, good luck. You're on your own. Right? Or you're going to pay a lot more because now you need it right before something happens. If you can get it, it's going to cost more because why? Because you're older or the taxes are more or whatever. Right? So why not mitigate as much risk as possible, put you in a better vehicle so you already know what's going to happen if something jumps out in front of you, a deer. You already know. Okay? Yeah. That's all I educate people on. Okay? So
that's good. I know a guest was saying that that's one of the only thing that you got to pay with money, but also with your health, right? And sometimes your health might cost you a lot more.
I don't care how rich you are. You can't buy your health.
Yeah. Now
you can do things, but sometimes it's irreversible, right? When you get to a certain point, you can't do things, right? But there are a lot of things that people can do where they can get requalified, but it's probably not going to be they're not going to get the best outcome had they done it earlier, right?
Best
and
deal.
Stuff.
Mm-hmm. Yeah. Now, Michael, I'm thinking right now, like, let's say I'm a business owner watching this or listening to this. Like, I got a big pain point. I'm paying $30,000, $50,000, $100,000, $200,000 in taxes every year. I don't know what to do. You telling me about those ultra wealthy and that this could be accessible to me, but then that this is not mainstream yet, right? Like, not a lot of people know that. My next question is why is that not mainstream if that is such a good strategy that everybody should have? Why is that not, like, that sounds too good to be true that some people might say. Why is that the case?
Yeah, I think so first of all, the law firm that holds this copyright, first of all, this was it's a trust structure, okay? Yeah. And we'll get more into it. Yeah. This was the first contract ever copyrighted back in 1999. Okay. and it was created back in the 50s actually by a Harvard professor, a combination of a Harvard professor whose background was on trust law. Okay. And that was Austin Scott. He wrote the book on Scott trust law, which is still being taught today in probably estate planning and contract law and stuff. Okay.
Okay.
He partnered with a fellow who worked on Wall Street in the financial, and his forte was contract law. Now, this is very unique because they joined this together. So here's the thing. Most contracts out here, as far as trusts go, they fall under legislative and tax law. This is under contract law. So the thing is, there are very few people, attorneys, that are educated on contract law. Okay. And you're going to find out that there are a lot of benefits of this being under contract law, that you get a lot of benefits when it's inside that type of contract versus, something that's not, that falls under tax law or legislative law. Okay.
Understood.
And that. So let me kind of back up. So I learn about things by reading, by surrounding myself with others. Just like what the Rockefellers did with life insurance, right? I had to go out and find it. I actually had a couple friends, and one moved away. I'm in Iowa. She moved to Colorado, and she reached out to one of my colleagues in the same city I'm at. I'm in Cedar Rapids, Iowa, and she was educating her on this this trust structure. Okay, so that's how I learned about it. Right? Okay. I had to know somebody, or somebody had to think of me to introduce this to myself. Okay. Which is the same thing with anybody that comes on here, right? You have to be introduced to it. And she was a direct distributor. She is no longer, and I have taken her place along with my other partner in that. So, but she and her partner educated us in that. But because this is, again, it's not a new concept. It's just new to me. Yeah. Right. Yeah. And I don't know where I was going with that. So, but why haven't people heard about this? Here's the thing. I'm one person, right? I can go out and meet with individual people. It's just going to take me longer. Yep. I believe I can help other advisors and their clients by working with those advisors to bring value add to their clients that nobody else is doing, not their CPAs, not their financial advisor, not their accountants, and all that. And it's a win-win, right? The client wins, the advisor wins, and I as a distributor win. Okay, nobody loses, and that's how I like to do business, right? I'm not one, hey, I'm going to do this because I make money. There's enough of those people out there, believe me. I don't need to be one of those. I tell people, Joey, I can sleep at night knowing that I did not do wrong by my client, right? Yeah. Because guess what? I'm not in the sales business. Even though we are, I'm not. I'm not looking for sales, right? I'm not looking to sell things. I'm looking for people who see value, and guess what? And I want to work with their future generations, but more importantly, they have relationships. If they're happy and saving all this money that I'm going to tell you about, that's a lifeline, right? They're helping their friends, they're helping those families, or they're helping those businesses, even competitors, right? These guys go to the same associations or the same conferences, just like Joey and you and I can go to a conference. We're competitors, but really we're not, right? We can pour into others and reap the benefits, right? Or we can keep it all to myself. It doesn't do anything to keep it to myself. It's no different. I have boxes of business cards in my cabinet. It doesn't do any good in there, right? Yeah. I just give them out, right? Like candy, right? Yeah. And that.
So basically the reason about is you would say that it's not that mainstream is that the people that owns that information, that contract law, is finite, right? At least right now, there's not a lot of people that has that. It's through different relationships and a network access that this
Right.
these processes are shared, and then it's just to find the right team and the right person that can help you with that type of planning, right?
Yeah, and that's all I'm saying is, I rather be in my office working with other advisors, right, adding value to them, and adding value to their clients versus, going like I'm going to be traveling to all these events where business owners are. That's time and money, right?
Yeah, for sure.
My time is worth more or more valuable to me to be working with people who already have relationships.
Yeah.
And
really
they don't have to be the expert. The client doesn't have to be the expert. We have the experts. We have in fact, the people that do our tax returns for these trusts own the trust themselves, and they do the taxes for the trust. All right. These are people who believe it and know it inside and out.
Yeah.
Okay.
Absolutely. No, that makes a lot of sense. And in terms of that, like that structure, if we go into the details of that proprietary structure, you said that if we use the same strategy that those ultra wealthy people have, some people can reduce up to 80, 90% of their taxation, of their tax liability from that. How does that work? How does that really minimize those tax burdens?
So it's actually 80 to 95%. And to believe it or not, even though that's high, that's conservative. Okay. I mean, I can tell you, I have one of my colleagues, my business partner, and that she has a good friend, just got the trust a couple of years ago, has a cleaning business, and her net profit, thank you, $600,000. She paid $300 in taxes. Now that's a 99.999%. Now, that's so if somebody actually uses this to their advantage, it can be more. Now, I rather underpromise and overdeliver, even though 80% is still high, right? Yeah. I think people would be happy with 40 to 60%. But I'm just saying, if you take advantage and learn this with this and work with the CPAs, the tax attorneys, accountants and stuff, you're going to be heavily surprised, right? And in turn, guess what? That's money that they can do and better their situation, put it back in their business, investments, whatever. Okay. It's just keeping more money in house than sending it out the window to the IRS. Okay.
That makes sense.
So, I can kind of go through a quick presentation if you want. Let me ask you, what other questions do you have? Because I think going through it a little might give you some,
I was going to go into, if you're able to kind of like, let's say I'm a 12-year-old and you have to explain to me how that person went from $600,000 to $300. Like, how does that happen? How do you go from point A to point B? Obviously, everybody's different, but if I can understand, like in the simplest terms possible, how did she do it? Well, it could help me figure out what could happen to me. So can you go into that?
Right. Yeah. Can you, do I have access to share screen?
Yeah, you can click share your screen. Entire window, and you can go ahead.
Okay, share screen. Now I will give you this. I already told you I was an educator, guys. Right? And the thing is, I keep things simple. And so now I taught elementary. So I taught second grade and fifth grade, and I have my administration degree. So and this is a work in progress, so it doesn't have all the features that I want. So, but I'm in the process of refining it to make things simple, right? Yeah. It's all about keeping things simple, because the more complex it is, people throw their hands up, right? Okay.
Yeah.
So, all right. So I already talked about own nothing, control everything. Actually, one of the businesses I own with a business partner, when we're doing joint work, our business is once. Own nothing, control everything. Once business strategies. But when I'm working with my group of people and my clients, it's under Safe Money Solutions. Okay.
Okay. Got it.
All right. So this screen is a lot going on here. So I'm going to walk you through this, but this is our current business structure that this is how every business works. that I have found. Okay. The revenue comes in, it comes into the LLC, LLP, S Corp, C Corp, however that business owner is structured. Okay.
Yep.
Then the expenses and deductions come out of that. The cost of goods sold, the payroll, the rent, the auto, whatever, the overhead. Yep. Okay. And then you kick out your income, the W-2, the 1099, or however, maybe a K-1. Okay.
Yep.
Before it goes anywhere else, you're going to pay taxes on that money. Okay. Yep. Up to 50% of that, depending on your tax bracket and depending on your state, you could pay up to 50% between federal and state taxes. And you see who's happy there? The tax man, Uncle Sam. Yeah. He's happy. He's walking away with your piles of money, and instead you're getting pennies on the dollar. Yeah. Okay. And you're unhappy because you're trying to figure out how am I gonna keep going, right? Yeah. But the thing is, once we get that revenue and pay the taxes, now we can go buy the things that we want. But now we're paying for it after tax dollars, right? The food, fun, fashion. There's a reason why those three are highlighted in orange, and we're going to talk about that. Yep. But food, fun, fashion. You're paying for your education or your kids' education. You're paying for homes. You're paying for cars, boats, travel, hobbies. Maybe you're buying businesses. Anything and everything is all after tax. Okay. Yep. So here's what the ultra wealthy do. Okay. They had the same revenue. Okay. Now I'll come back to the figures just so I can explain it, but I want to explain the whole structure here. So the revenue is no different. Okay. Yep. The way that, can you see that screen?
Not okay. Now, yes, I can see. Yep.
Okay. I'm going to back up here. We'll do a takeover on this.
Yep.
Okay, so we're going to talk about what the ultra wealthy do and have done. Okay, yep. They're just working their business differently. All they're doing is how they're moving money around. Okay, they still have the same revenue coming in. We're going to talk about the revenue, the dollar figures, but I'm going to come back to those. The revenue that comes in, okay, if it goes into this structure, this trust structure, you would have a business trust. That's for the business active income. And then you have a beneficial trust. Okay. And the beneficial trust is ultimately, it's for the benefit of the beneficiaries, your kids, your grandkids, your great-great-grandkids, charities, whatever. Okay. But the thing is, with this type of structure, you do not have to have an LLC, an S Corp, a C Corp, and all that. You do not need to be registered at the state level and be beholden to the state tax rules and legislation. Okay? Any monies that go into the business trust and the beneficial trust go in pre-tax dollars. So meaning this revenue, $10 million goes into this trust, and the taxes are deferred. The taxes are deferred until until there's no beneficiary remaining. So meaning these trusts go on for 200, 300, 400 years, long after you're gone, just like the Rockefellers, John Rockefeller. Yeah. Things he set in place, it's still going, and he's been gone, right? So these are legacy plays and stuff. But the $10 million would go into this business trust. Now, typically, a business owner has probably been paying themselves quite a bit. If they're making $10 million, right? They're paying themselves a good revenue. Here's the thing. When you do this, you don't have to pay yourself as much, because you're going to find out that the trust, the beneficial trust, will be paying most of your things that you're buying already. Okay. The only thing that the trust cannot purchase, that you have to have money outside, is food, fun, fashion, and travel. Okay. Because that cannot, the trust cannot pay this for the benefit, for the trustee. Got it. So Joey, you would be the trustee, and your wife is trustee, or, husband and wife, husband, spouse, right? Typically they're the trustee. Okay. So the thing is, we still work this business but we're working it out of the trust, but the deductions still work the same. We're not changing the accounting of it. It's just how the money is flowing through this structure. Okay.
Yeah.
And then we have profits. So let me go back to the numbers here. Okay. So we have a $10 million revenue. Okay. Yeah. We're going to pay ourselves in this situation. We're going to pay ourselves $500,000. So that's all we're paying taxes on. This person might have been paying themselves $3 million. So we've just reduced their tax liability to $500,000. Number one, right? So now we have $9.5 million in our business trust. We're going to pay our expenses. Let's just say our expenses are $4 million. After the deductions and expenses, we are left with a profit of $5.5 million.
Okay.
Okay. All this inside the business trust and up through the beneficial trust, these are pre-tax dollars. The taxes, like I said, are deferred. Just consider it indefinitely. Okay.
Okay.
Unless you do something to screw up and taking money out wrongly. Okay. And which we don't. Well, that's why we work with the professionals.
Yeah.
So really, the business trust is a pass through to the beneficial trust. Okay. So that $5.5 million is going to go in the beneficial trust, and again, it still has that pre-tax dollars.
Got
okay.
It.
Here's the thing. Now we can go buy the things that we want to buy with pre-tax dollars. We buy the homes. We buy the cars. This trust can buy investments, after-tax investments. So the only thing that the trust cannot own, what can't go in the trust are W-2 income directly, and it cannot own individual retirement accounts, qualified accounts, Roth IRAs, 401ks, all the numbers, retirement account type numbers, right? Those cannot go into the trust directly. And that. So that 5.5 becomes retained capital. So as long as that is held inside the corpus, remains tax deferred. Now, what makes the corpus is the plan. Okay. What's unique with this trust is it's actually held inside of an escrow account, which gives us all these tax benefits. Okay. So we can retain capital. Family and lifestyle, we can do the things to purchase those things. So homes, cars, investments, insurance. For beneficiaries, it's the HEMS, health, education, maintenance, and support. Okay, so pretty much anything for the beneficiaries, you can pay for. Now the whole thing is you don't pay them. You don't give them the money. You pay the college directly. You give them an allowance. Okay. Not cash, right? It might be money on a card or whatever. So, right. So, and that again, now here's the beautiful thing about this. This is going to be a lot of your business owners. There are certain things when it's inside this trust, it's not considered income by the IRS. This is the passive income features. Capital gains, income brokerage accounts. Those brokerage accounts, they're going to gain. But this trust there's two things. This trust cannot be forced to pay any taxes out. Okay. That could be taxes or if your trust is ever sued, because this has a discretionary provision. The discretionary provision is it's up to the trustees if they want to pay money out. This trust cannot be forced to pay money out, unlike other trusts. Okay.
Understood.
So capital gains. How many business owners are selling their business? Right? Yeah. What percent do the business owners pay on the capital gains of the sale of their business?
I would say a lot. Probably up there.
20%.
Yeah.
Guess what? If your trust owns the business, that $50 million that business owner gets pays no taxes.
Let's go from 20 to 0.
20 to 0. Okay. Royalty income. Okay. Royalty. So for example, when I'm just using my example, when I am marketing this structure and I have somebody that purchased this, that income is a royalty to me. I don't pay taxes on it.
Yeah, that makes sense. Yeah.
Interest and dividends, not considered income under IRS. K1 distributions, again, passive income, no taxes. When I say that 80 to 95%, that's a big number. This is why.
Yeah, that's crazy. That is really
okay.
Insightful.
Now let me kind of any questions on this? I mean, I'm trying to keep it as simple as possible. But
that's super helpful with the graphics. If you're listening to that, make sure you go to the YouTube video so you can see the graphics, because it makes a lot of sense.
Yeah.
It's essentially what I'm getting out of this is that you're going to try to make as much expenses as you can with your pre-tax dollar than with the after-tax. I think that's the big problem or issue that this structure is tackling, right?
Yeah. Yeah. Here's another question real quick, Joey, or another thing. How many business owners at the end of the year, their CPA is telling them to go buy stuff, just to buy stuff?
Yeah, all the time.
With this, you don't need to buy stuff if you don't need it, because remember, we're working with pre-tax dollars here, right? Yeah. You don't need to do that stuff. Rental income. Now, for those of people that invest in real estate, that income is basically tax-free. Okay, it's not considered income, but we don't have to worry about 1031 exchange rules, because you could put a property in here day one, turn around and sell that rental day two. You don't have those hold periods, those you have to get rid of it within so many days, do a like to like and all of that. You can sell the property, go buy a boat. You can sell a single family home and go buy an apartment complex. There's no rules, right? Who makes the rules? Yeah. Well, you're in control. I mean, there are rules, but you're in control. You're not reliant on the government rules that are set out there. Okay.
And to get something set up like that, does my business have to make 10 million, or can I start with like when I'm making 6 figures in profit? Would that still work?
Here's the thing. One is a tax side and one is a protection. I have some people that are paying $30,000 in taxes, but they want this because, number one, they know their income is going to grow. Number two, they want the protection and the privacy. So this is the ultimate asset privacy and invisibility contract structure. Okay. It's the ultimate asset protection and control. It's the ultimate tax advantage structure out there. Okay. And as far as I know, the biggest thing, this, as far as I know, is the only trust that is under contract law. Everybody else is on legislative and tax law. Okay, this takes those into account, so it already covers all that, but this is under contract, meaning unless there's fraudulent conveyance, meaning let's say somebody's getting divorced and now you're trying to hide money, right? If you've already been sued or in the process of being sued, right, that's fraudulent conveyance. So if you're doing it for the intent of hiding money, that's fraudulent conveyance. Other than that, no judge can overturn this and see inside this trust. It is a blind trust. They cannot see, or anybody cannot see the assets, the trustees, the beneficiaries.
Yeah, that makes sense.
So ultimate protection. Even your beneficiaries have no rights to see what's inside the trust. They are just benefiting. Okay. The only way somebody finds out about your trust, because unlike other trusts, which are alter ego, which means you've used your social security number in exchange for an EIN number, okay? Meaning you applied for it, or your attorney did, using your social security number. And this is a non-grantor trust. A non-grantor means a third party is applying for the EIN number and creating the trust on your behalf. Okay.
Got it.
When your assets go into this trust, you are no longer the owner. Now, with most trust, you lose control. With this trust, you do not lose control. You are in control. You just don't own the assets. So what the biggest hurdle over this is people have to put their ego aside. Okay.
Yeah.
To say it's in their name. Anything that's in your name is up for grabs, right? Yeah. Your LLCs is connected. It's limited liability, or anybody can sue you, right? For any of those, they can sue you personally. So putting the ego aside is one of the biggest things, and people think losing control. Yes, I would say typically, yes, you do lose control, but in this case, we don't. The other side of it, most people have banks in control of their trust. We do not allow banks to be in control. They cannot be in control of this trust. It's not allowed, because then it loses all the benefits. Okay. And people have found when they give the bank the control, they can just use that money for themselves and cut them out. Okay.
Yeah. It doesn't work.
It doesn't. So there are some businesses that you will still have to have a registered entity, an LLC or some structure, because if you are required to hold a license inside an LLC, so for example, maybe doctors, right? Yep. Insurance advisors, we cannot be paid directly to a trust. So either you're going to be paid personally, or ideally through an LLC or something like that. Yeah. Again, that's a tax CPAs questions. But basically whatever those monies are, you do the same expenses. But let me go to the last slide here. This is all it's showing. It's showing the revenue, that same $10 million revenue coming in to the LLC like it always does. You're going to pay yourself just to cover the food, fund, fashion, your same deductions. However, now we consider this $5.5 million as extraordinary dividends. Extraordinary dividends, when it goes, it can go directly into the business trust, and those are pre-tax dollars. And then it works all the same way. Okay. So you can go buy everything with pre-tax dollars, right? Instead of trying to depreciate stuff. Now you can still do depreciation, but you wouldn't do it inside the trust. If you're trying to depreciate things because your CPA says, hey, let's depreciate. Once it's depreciated, then you can put it into the trust. But the thing is, you still have that liability exposure, right? And that, but when you go to sell those rentals and that, as long as that money comes back to the trust, the corpus of the trust, there is no taxable implication. Now, everything that a person puts into this trust when they're transferring their homes, let's take a home, their cost basis for what they bought the home for, plus any improvements, goes towards a promissory note. So everything, intellectual property, so your education, what you paid for your college, what you paid for your kids' college, that goes towards the promissory note. Knowledge is valuable, okay? Courses, anything you've done along the way. And you can draw upon that promissory note without any tax obligation ramifications. So that's one way to get it, or you can do a withdrawal, and then you'll probably pay some taxes. So I don't know why somebody would withdraw versus, hey, I'm just going to take up my promissory note. You can always pay it back if you want, but you don't have to. Okay. Inside these trusts, so these trusts can own life insurance. So my trust owns all my life insurance policies. It's the owner, it's the beneficiary, it's the payer. Okay. Same thing with businesses. It owns the business, it owns the buildings, it pays the insurance and all that. So, and that, I know I'm just kind of reiterating some of this, but this is big stuff. I mean, and I'm just fortunate enough that I came across this and took the time to learn more. And now I'm educating more because I want this to get out in the mainstream with the professionals that I want to work with. Right. Yeah. So we can take this to more people and help more people.
That's amazing, Michael. No, thank you for sharing that. So Michael, thank you for sharing all of that. I think with the design and stuff, I think simplicity is harder. It's harder than complexity in most cases. So hopefully a lot of people saw value into that and they can see that this could be beneficial for them. But before we go into that, I want to ask you, what are the biggest misconceptions that business owners have about what you just shared and those maybe advanced tax and asset protection strategies? What are the reasons someone wouldn't do that?
It's no different when I'm working with somebody on their retirement, and I'm, showing them how to have guaranteed income, right? For an annuity will do that, right? Or guaranteed growth. Well, I need to check with my CPA. I need to check with my financial advisor. Well, my first question is, what's that conversation look like? Because I can tell you right now, there's nothing positive that's going to come out of that. There's nothing positive that's going to come out of that. Well, meaning they're not going to say, "Oh yeah, you should put money into this or transfer this money," right? There's nothing positive. So a lot of times they want to go back to their professionals that they're working with. Now, we're not here to destroy relationships, because the thing is, we can play nice in the sand, right? But the thing is, I know that their professionals are not doing this. I already know. Everybody I talk to, I already know they're not doing anything like this, right? Because there's a very minute group of people that's doing it. Okay, that have even known about this. I think just educating them, because it's a new concept. People are skeptical. There's scams all around. I mean, I get scammed all the time. I mean, and look, I'm professional and I'm careful, but I've been scammed. Right? It's too good to be true. And the thing is, as much as I would love to help people, I want people who want help. Yeah. I want people who want guidance, and they're at least open-minded to learn about new concepts, new ideas, new strategies that can really impact them today, but more so generationally. And that. This is an irrevocable. I think I don't know if I mentioned that. So it is an irrevocable. So it's a non-grantor. Irrevocable. Yeah. Irrevocable means once you put the assets in, you can't take them out. And the thing is, you wouldn't want to take them out, because now you would be pulling it out. Now that's free reign. Now you've lost all the tax benefits. So you wouldn't want to do that, right? So part of it is, before you do that, so when my clients are planning on doing something, they're talking to the professional to say, how should I buy this land? How should I buy this business? Should my business do it? Business trust? Should my beneficial trust? What does that look like? Right? Because once you do it, it could be a big mistake, right? So we want to make sure that we're communicating. A lot of that is communicating, right? This is a relationship business, because this is going to carry on to their kids and grandkids if we continue to educate them how to keep the system going, right? Yeah. A well-oiled machine and that. Let's see. I'm trying to think. Yeah. So
do you think the biggest misconception is that most business owners think it's too good to be true and they do it the wrong way, or they rely on the wrong person to do that for them and some mistake happens?
Yeah, I think the biggest, it is the education part. It is, like I say, I'm the quarterback. I know enough to be dangerous. Yeah. But I'm by no means the expert, but I have the experts that work with me and for me, right? That I've partnered with and that will partner with my clients, right? So, not one person can know everything. So why try to be you just want to be a resource to that client. When they have a problem, even in the things that I don't do, they know that I know enough or know a lot of people and have a lot of connections. They'll come to me, even things outside, should I buy a Toyota? Well, some of them know I worked at Toyota once and I own Toyotas, right? So they're coming to me, getting my advice, and then I'm sending them to my Toyota person if they're local. They just want to communicate with somebody versus calling somebody up, and there's a trust factor, right? And if you cross one person wrong,
now you're done.
You've lost them and any potential revenue streams that can come out of, right? And
it's a big relationship game, huh? I think it's a big relationship game.
It is.
And lucky for us today, it's easier than ever to find those relationships. And I think that knowledge will become more and more mainstream, hopefully, with everything with AI and social media, and be able to share those results in platforms like this. So do you think it will be a good thing that more people
here's the thing. Again, full transparency. There are a few people out there on social media that do market this. They are distributors. Yeah. Some of the things I don't believe they're telling the truth. So again, you want to vet the person. So, but they're saying things that aren't true. And then you have people that are kind of knockoffs, right? Yeah. It sounds like it, but then there's a little twist. Some people are saying, well, you would put an LLC into this trust. No, you wouldn't. There's not in our trust. Okay. You would add a foundation. In fact, Joey, here's how crazy it is. I have a group of advisors that I work with. They were, the leader brought this attorney in, and he pitched a trust very similar. However, it had a foundation. Now, with a foundation, again, I'm not the knowledge on this, but with a foundation, you have to put so much money or a percentage of money in that foundation. But what these people are finding out is they have hundreds and thousands, if not millions of dollars in these foundations they can't access. The only one way is they can lend it, they can loan it back to themselves and pay the interest back, but they cannot access that money, or it has to be distributed.
Yeah.
So there are some things that we can and can't do. Some things we can rectify, but sometimes we can't. So sometimes it's like, quit putting money there and making your situation worse, and let's just redirect into this structure. So again, we're also in, what do you call that? We're in the reactive on what they've done already.
Yeah.
Right.
Yeah. So it's planning early. It's planning early and taking that seriously.
It is. It very much is. And, I tell clients, it might be, it could be 4 or 5 times before we even do anything, right? On anything that I do, right? I have to understand the client. I'm a doctor. I am trying to diagnose your ailments, your problems, your issues. I can't prescribe something unless I know what it is. So even if your best friend has the same condition and you say they're taking this medication, and you come to the doctor and say, I want that medication, that's my friend, they're not going to give you that medication. They are going to run blood tests. They are going to run tests. No different. I do not recommend anything on a first appointment. There's nothing to buy. There's nothing to sell. It might not even happen on the second or third or fourth, and sometimes fifth and later on. But the thing is, we're trying to build a strong foundation. Whatever we do, and that's where this trust comes in. This trust structure is the foundation. We don't want to start building inside this structure or on this structure until we have that foundation, because we don't want to do things in vain. We want to make sure whatever we're building is going to withstand the storms, the hail, the wind, the hurricanes, the cyclones, the hurricanes, the hail, right? This is no different. We want to make sure we get things properly structured from the beginning, the right way, so we're not doing damage control before we move on to the next thing. So it's steps, right? Because believe me, this is one strategy. There's multiples. There's things that everybody else on this call does. That's a strategy, and some things are proprietary to us and the professionals we work with.
Yeah.
That's it,
That's really good. And Michael, if you could change one thing about how business owners think about the relationship with the tax system, what would that be?
Quit worrying about deductions.
Yeah.
Trying to get all the deductions. Yeah. You can only do so much to get deductions, and why spend more than what you have to because your CPAs is forcing you to buy things just to pay less in taxes. You know, so I think it's just a change of mindset. There's a better way to conduct your business, and if you're open-minded and willing to learn and work with professionals that this is what they do, it's like winning the lottery. Not only today, but next year and every year going forward. Forever. You will never have to worry about your family and what it becomes.
That's really powerful.
So this is a legacy play also. I mean, that's really what it becomes, is a legacy play. It's a tax play, it's a legacy play, it's a protection play. We got airbags around the clients. Literally. We have airbags from all these outside forces that want your money because they can see it. When an attorney wants to sue, they pull up, they run your name and see all your assets. Well, what if your assets are inside this trust? They're not going to see anything attached to your name.
That's good. That's crazy value that we're adding there. So hopefully business owners can see that. And again, I think you got to find the right team, and people like Michael can help in that area. It's being careful who you see, and it's always making your research first and looking at the track record, right? And that's always the most important thing. It's the implementation of those things. When you talk about legacy, we have a recurring segment that we like to ask after each episode, which is a legacy question, which is, if this episode were to outlive you, right? What's one lesson about business owner tax strategy you would like every entrepreneur to remember?
It's a big one. I mean, it's a big question, right? What do I want every entrepreneur? Quit following the traditional system because it won't get you anywhere. You're working for dollars.
That's really good.
You're running in circles. You're giving up more than your fair share. I'm not saying you shouldn't pay taxes, but only pay the taxes that you're obligated to pay on, as long as you take advantage of the tax code.
That's really good. That's really good. Michael, thank you. Thank you for your time.
Joey.
Thank you for being an open book.
This has been fun.
That was really good. That was really good. And what I want to say to the business owner watching this, if you made it to the end, the only thing we ask in return, if you want to learn more and know more about all those little tips and tricks that we're sharing, we're going to bring on an elite expert every week. So please subscribe to the channel, share this with a business owner that you know, so that this knowledge gets passed around as much as possible. And subscribe and comment down below what was your biggest takeaway. And there's going to be value like that dropping every week. So that's the only thing we're asking. And again, Michael, thank you for your time, and we'll see you all in the next one.